In the previous classes, we were discussing about the components of a financial system. The first component is financial market. Financial market is a place where financial assets are created and exchanged. It is a place where buying and selling of securities takes place. We saw that the financial market is of different types. The second one is financial assets. Financial assets are those assets which are used for further production of goods, or those assets which would be earning you some sort of a return in the form of dividend, interest, etc. Third component is financial intermediaries or financial institutions. This is a topic that we will be discussing in today's class. So, who are financial intermediaries? Or what are financial institutions? All kinds of organizations which intermediate and facilitate financial transactions of individuals as well as corporate customers are known as financial intermediaries. So these are the middlemen, or these are the facilitators who ensure that financial transactions takes place between two individuals or two corporates. All kinds of financial institutions and investing institutions which facilitate financial transactions in financial market can be termed as a financial intermediary or financial institutions. What are the different types of intermediaries? Financial intermediaries are mainly classified into organized sector and the unorganized sector. We'll first explain what is the unorganized sector. The unorganized sector consists of money lenders, indigenous bankers, and pawnbrokers. These are the intermediaries who are not regulated by the RBI or by Securities Exchange Board of India or any other regulatory authority. These intermediaries are free from control. So we already explained who is a money lender and indigenous bank. I hope you remember. Money lenders are those who lend surplus funds in their hands. Indigenous bankers are individuals who accept deposits from the public. They will be giving a small rate of interest for that, and they will also be lending the money that they collected. Now, who are pawnbrokers? Pawnbrokers are those who will accept valuables from your hand as security and then lend money to you. For example, if you're in urgent need of cash and you have some gold with you, you could hand over that gold to the pawnbroker and get money. You'll have to pay interest at regular intervals to the pawnbroker, and after a fixed period of time, you have to pay back the whole amount and take the security back. In case you make any default, that is, if you are not able to pay back the money that you took as loan, then the pawnbroker will be sending you notice that you'll have to pay back. And if you're not responding in any way, then the pawnbroker has got the right to sell the valuable that you gave to them and get the money back. That is, the gold that you gave will be sold and auctioned, or the money that they gave as loan will be taken back. So that is with regard to the unorganized sector. Now there is the organized sector. The organized sector is the one which is under the regulation of the RBI or the Securities Exchange Board of India. Organized sector is classified into money market intermediaries and capital market intermediaries. So money market, we are familiar with the term money market because I explained it when we were discussing about financial markets. Money market is a market for short-term securities. That is, securities with a maturity period of less than 1 year. So money market intermediaries are those who facilitate financial transactions in the money market. Those intermediaries who deals in securities with a maturity period of less than 1 year are known as money market intermediaries. Who are the main players in the money market? First one is RBI, the Reserve Bank of India, which is the Central Bank of India. Reserve Bank of India is the one in charge of circulation of funds in the country. It is the one that issues currency notes and coins. It is also the lender of last resort because the RBI gives money to the commercial banks when they are in urgent need of it, and they will lend money to the commercial banks for a emergency. That is why RBI is known as the lender of last resort. The second one is commercial banks. Commercial banks are those banks which accept deposits and lend money to the public. They are they have the right to issue demand drafts, checks, etc. Commercial banks will accept the deposits at a low rate of interest and they will be lending that money to those who are in need at a higher rate of interest. The difference between these two interest rates forms the profit of commercial banks. The commercial banks of India are regulated by the Banking Regulation Act. And the commercial banks are money market intermediaries. They will be providing short-term loans to industries and they will also be dealing in short-term securities. So they will be facilitating the trading in these instruments. That is why they come under money market intermediaries. Third one is cooperative banks. Cooperative banks are formed by a group of people who are interested in developing either small industries or in developing the agricultural sector. So they are a group of people who come together, they put their funds together, and the members of the cooperative banks can take loans when they are facing a crisis. So cooperative banks are regulated by the Cooperative Societies Act. The cooperative banks provide equal voting rights to all its members. That is, one member has one vote. It is not based upon the amount that you deposit in the bank or the amount that you take as loan from the bank, but everyone is treated equally. So cooperative banks are created with service mind. They are service oriented banks. Their main purpose is to develop a particular area by helping the small investors or the artisans, farmers, etc. Fourth one is Post Office Savings Bank. Post Office Savings Bank, that is, a post office is offering various schemes. These schemes are all safe to invest in because the return is assured. The return might be a small amount, but you will be getting the returns at regular intervals. So it is risk-free securities, and the post office is the one who is acting as the intermediary in that securities. So they will also form part of the money market intermediary. Last one is government. The government is an intermediary in both the money market as well as the capital market. This is because the government deals in securities which have maturity period of less than 1 year and maturity period of more than 1 year. The securities issued by the government is known as gilt-edged securities, or they are also known as GSEC, SEC. Now, the central government and the state government, both these government has got the right to issue securities. The central government is the one that issues bonds and treasury bills. State government usually issues bonds or dated securities which are known under the name of state development loans. That is, the dated securities are those securities which have maturity period of less than 91 days. These are issued by the state government and it is also known as state development loan. Central government usually issues bonds and treasury bills. Bonds are for a longer period of time, more than 1 year. Treasury bills are issued for a period of 91 days or 182 days or 364 days. There are three categories. Treasury bills are also known as T-bills. They are promissory notes issued by the government of India. It is issued when the government urgently needs to raise some funds from the public. Now, these T-bills do not carry any interest rates. They will be issued at a value which is lower than the face value of the security, and then after the period of time it will be redeemed at the face value. That is, a treasury bill which is worth rupees 100 might be issued at rupees 95, will be made available to you for rupees 95, and after 91 days it will be refunded as rupees 100. So 5 rupee gain. Obviously, it will not be issued for a small amount as 100, but when the huge amount comes, the difference will make a huge profit. So these are with regard to the money market intermediaries. Now coming to capital market intermediaries. Who are capital market intermediaries? We are already familiar with the term capital market. It is a market which deals in securities with a maturity period of more than 365 days. So the intermediaries in this market is known as capital market. First one is development banks. How are development banks different from commercial banks? While commercial banks concentrates on collecting deposits and lending funds, development banks will also provide all the activities which are needed for the development of the industrial sector. That is, they will be giving loans, they will underwrite the securities of industries. You know what is underwriting, right? When a company issues shares, we will have underwriters who will assure that they will subscribe to the unsubscribed securities of the company. When you're making an offer to sell your shares to the public, that is, you're issuing 10,000 shares and hoping that the public will subscribe to those shares, you need a minimum subscription of 5,000 shares to start your company, but you're getting only 4,500 subscriptions from the public. Then the remaining 500 shares will be taken by the development banks. They will subscribe to that. They're standing guarantee that they will subscribe to the unsubscribed portion of the share capital. That is why they are called underwriters. So they provide underwriting services. They will invest in profitable business ventures. They will stand as guarantor also to the loans that the industries take or for the deferred payment, that is a payment remaining on purchase of machinery, furniture for the company, etc. Not furniture, sorry, machineries of the company and other land, building, etc. So they will stand as guarantee. So they are offering various other services apart from accepting deposits and lending money. Now, examples of development banks are IFCI, which is the first development bank, first specialized institution that caters to the needs of medium and long-term financial institutions. Then IDBI is an example, Industrial Development Bank of India. IDBI was established for meeting the growing financial needs of industrialization and for coordinating and assisting the growth of industries. It is the apex bank. It is a bank which controls all other development banks. So it's the apex bank. IDBI handed over some of its functions to Small Industries Development Bank of India, which focuses on catering to the needs of those industries in the small scale sector. So IDBI also has control over TCO, which is Technical Consultancy Organization, which focuses on providing expert advice to industries at affordable consultancy rates. So IDBI has both SIDBI, that is SIDBI, and TCO to assist the development of industries in the country. It also has various other subsidiaries below it. ICICI is also an example of a development bank. It is a private sector development bank. So all these development banks are intermediaries in the capital market. Second one is insurance companies. We know there are two types of insurance, general insurance as well as life insurance. General insurance deals with marine insurance, fire insurance, health insurance, vehicle insurance, etc. And life insurance deals with securing life. So insurance companies will also be intermediaries who collect funds from the savers in the form of insurance premiums at regular intervals, and the premiums that they collect will be invested in the industrial sector. So they are also a major intermediary in the capital market. Third one is government. I said governments are intermediaries both in the money market as well as the capital market. So government will be issuing bonds for a period of more than 364 days. That is why they are considered as capital market intermediaries. Government is also the intermediary that facilitate investment in provident funds and national savings certificates. So they are a major player. Next one is Exim Bank, also known as Export Import Bank. These banks finance export-import activities. They also provide finance for joint ventures with foreign companies. And they also provide merchant banking functions to the businesses that deals in foreign exchange. That is, they will provide consultancy service, advisory services. They will provide all sort of assistance for developing the export and import sector, for developing the foreign trade of the company. Last one is NBFCs, non-banking financial companies. The non-banking financial companies are governed under the Companies Act. They cannot accept deposits from the public. They are involved in providing various other financial services such as hire purchase service, leasing, investment, finance, etc. All these are handled by non-banking financial companies. They are different from the commercial bank and cooperative bank. They are focused on providing assistance to the industries by providing various financial services, and it is governed by the Companies Act. So the different financial intermediaries in India are classified into the organized sector and unorganized sector. Major players in the unorganized sector is money lenders, indigenous bankers, and pawnbrokers. The organized sector has money market intermediaries as well as capital market intermediaries. Major players in the money market are RBI, commercial banks, cooperative banks, post office, and government. Major players in the capital market are development banks, insurance companies, again the government, Exim Bank, and non-banking financial companies. Now coming to the fourth component of financial system is financial services or financial intermediaries. All those activities that have a financial nature are classified as financial services. It is a process by which funds are mobilized from a large number of savers and made available to those who are in need of it, particularly those in the corporate sector. So all those activities that have a financial nature can be considered as financial services or financial intermediaries. The financial services are broadly classified into fund-based services and non-fund-based services. Our second module and third module deals with fund-based services and non-fund-based services. So we will look into that in detail in the coming classes because the next module is about that. So right now you just need to know what are financial services. So with that, we come to an end. If you have doubts, you can leave the messages in the comment box. Thank you.